Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 16th of November. I'm Daniel Lam, your host for the podcast. Last Sunday was a very memorable one. My 4-year-old boy and I went to watch the World RX car race near the harbourfront in Hong Kong, where my boy had his first ever media interview from a newspaper reporter, and we also ended up on the TV news program from video shots at the spectators. But unfortunately, an apartment within our building caught fire, and it was chaotic for us to rush back after the car race. And the apartment building was filled with a burnt smell, and we scrambled to reunite with my helper and also my baby girl. So afterwards, my mother said that we're going to watch out for the unexpected at all times. I guess translating that into financial language, it means we have to watch out for volatility. But VIX, which is the short-term S&P 500 volatility index, have been extremely subdued this year. So why is that, and what to expect going forward? Well, lately, we've had a softer batch of economic data in the US, and this mild slowdown has been creeping into the US sectors with narrowing dispersion in the sector output PMI. So in layman's terms, the slowdown in the economy is beginning to impact all the sectors, and this is resulting in rising delinquencies in consumer loans and corporate bankruptcies, although so far, those are at a measured pace. The high real rates and cost of capital is normalizing margins and weakening debt serviceability in a number of US companies. But the growth companies are holding up well due to strong demand for their high value-added services. This defensiveness, as well as differentiation of services from such high-quality companies, make them less sensitive to macro volatility. Now, in fact, the high dispersion on the sector-level earnings contributes heavily to the low, quote-unquote, overall level of volatility on an index basis. On the macro front, monetary policy is a primary driver of equity volatility regimes. But historically, there could be significant lag of 2 to 3 years. In other words, we could, quote-unquote, still be under an extremely easy post-pandemic monetary policy in the near term, as far as volatility is concerned. So volatility may stay low in the near term, and we continue to believe that US 10-year Treasury yield may be capped at the 4.6 to 4.8 area, and this represents tailwinds for growth-oriented stocks, such as those in the US technology and communication services space. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.